All right, let's talk about more high-yield dividend stocks. I'm Jason Hall. This is The Smattering, and we got two great new ideas here for you. I'm joined by my good friend Tyler Crowe. Hey, Tyler.
Always great to be here, and always enjoy talking about high yield.
Yeah, let's get the people paid. We like it too. So before we get started, just a reminder, we get to make these videos because of the Motley Fool and our partnership with the Fool. If you're looking for even more great stock ideas, go to our link, fool.com/The Smattering. And the Fool is going to give you its 10 best stocks to buy right now. Okay, Tyler, what's that stock?
Yeah. So tell me if you've heard this before from me, but it's a company few have heard much of. It's called Pinnacle West Capital Corporation, which it doesn't make any sense in what it actually is. It's a regulated electric utility. It's the state of Arizona's largest regulated electric utility. And one of the reasons that I like this company in particular is, for one, utilities on the whole have been one of the better places for investors over long-term buy and hold periods on a total return basis. You know, we always talk about price appreciation as kind of the proxy for investors, but for wealth creation, total returns matter. How much you're getting in dividends, how much those dividends grow. It's a huge component of long-term success in the market. And that's why utilities have been one of the more attractive investments for people. What attracts me to Pinnacle West in particular in the utility space right now is that, number one, the state of Arizona is one of the states that is benefiting the most from demographic trends in the United States. It has population growth. It also has pretty robust economic growth relative to the nation. People in the workforce are moving there. Mm-hmm. So that is, they have one of the higher net inflows.
It's the western edge of the Sun Belt, right? Right. It's where people are moving. It's where costs of living are lower. There's more economic opportunity.
Mm-hmm. So there is a lot going on in the demographic trends of Arizona that is inevitably going to lead to increases in electricity usage. And for a regulated utility, that's just music to their ears. On top of that, Arizona has a relatively favorable regulatory environment for its utilities. So, you know, basically, if you're regulated, you have to get approval on everything that you do. And for the next several years, Pinnacle West has approved somewhere in the range of 5 to 6% increases on their base rate, which is basically how much they can charge for their electricity outside of fuel costs, which is where they generate all the profit. Base rate is where all your money is made. So all of those things kind of put together make for a utility company that has a little bit more growth than most of the industry, but at the same time, it has one of the more favorable dividend yields at 4.3%. It's one of the highest in the utility industry right now. And even with modest dividend growth at that rate, it looks like a good total return business. We were talking before the show, a good comp to them is NextEra Energy, absent the kind of an unregulated part of what they do. Same demographic trends, but at the same time, you're getting double the yield approximately of what NextEra Energy typically provides.
That's awesome, Tyler. Thanks for bringing that to the table. I'm gonna talk about a business that's maybe maybe a combination of a little less appreciated, and also there's maybe the jury's a little more out on what its future is going to look like as compared to its past, and that's Blackstone. So Blackstone is one of the largest alternative asset managers in the world. The stock's down maybe a third or so from the high, and the entire cohort of alternative asset management companies, these companies that get their 2 and 20 by offering investors and managing money for things like real estate, debts, things that are alternatives to, that are uncorrelated with the stock and the bond market. This is their
Jason,
business. Right?
Explain 2 and 20 for everybody.
Good call. Basically, 2 and 20 is how they make money. They earn 2% of all assets under management. This is the piece that they take right off the top. And then they earn 20% of excess returns above certain thresholds. So they earn 20% of the excess returns. It creates alignment to outperform whatever the benchmark is, so they get more earnings. So that's the 2 and 20 model. It's a great business to be in, right? And it's a great business to own, I think, is the key. So I think about Blackstone right now. I think about the alternative asset management business in its entirety, the market views the assets under management that these businesses have is maybe being less valuable than these managers are reporting. We look at what's happened with the stock market. We look at some commercial real estate values. For Blackstone, that's really important, right? And maybe that's part of the reason the stock has come down. There's also the reality over the past 25 years that as an industry, it has certainly benefited from the tailwind of the ultra low interest rate environment that we've been in, where we see these very high net wealth investors, family office of billionaires, or it's Harvard's endowment or a pension fund that have gone to these alternative asset managers for exposure to those uncorrelated assets to help them achieve whatever their financial goals are for their giant buckets of money. And there's the risk that higher interest rates could mean less of that money goes to alternative assets and more of it just goes into bonds, where you can get that predictable yield, particularly if we see treasuries and longer term treasuries generate a higher yield over time. I think that's overstated. Okay, so that's why I think that this is a really interesting stock and why Blackstone is particularly compelling to me. So first thing, I'm going to take the dividend off and we'll just look at the yield. And right now it's about 6.2%, which is kind of in the middle higher end of where it's been over the past decade. I think to me, it's certainly, if we were to use it as a proxy for valuation, which we need to be careful about, it says that this is a company that's at least fairly valued, if maybe not a little bit on the cheap side. But I do want to talk about its dividend, particularly after Tyler was just talking about Pinnacle West, which pays a steady, predictable, same dividend every quarter, and then they grow it, and they pay it, and then they grow it. Blackstone's dividend is variable. But the long-term trend with that dividend, again, has been growth. And I think if you're looking for exposure to more real estate, I think Blackstone's really compelling right now for high-yield dividend investors looking for some long-term growth.